educator. Thank you, YouTube. Hello. Um, my name is Toria Howard. I'm an educator by day. I teach sixth through eighth grade, lovely students reading, but I'm also a realtor. Shout out to me for passing my real estate exam in Michigan the first time. And I'm a realtor in Tennessee as well. And I'm a financial literacy educator and a business funding broker. So, but today we're talking real estate. So let's get into it. I got to put my timer on. Hold on, because I got to make sure I'm staying in alignment with my time. I got a new watch, so bear with me. I'm trying to make sure I do this right because certain people say I'll be talking too long, I'll be doing too much. So 10 minutes is what I got. So here we go. Um, I know a lot of times when people talk about home ownership, they talk about people are that are looking for homes or just now starting their home ownership journey. But the current homeowners need some love too. So with me being a financial literacy educator, I understand that it takes a lot to buy a home, but it also takes even more to be able to keep it and turn it into something that can pay you, right? So to start off, what is it that a first-time home buyer can do? Because I'm always on money mindset. So what is something that a first-time home buyer can do first and foremost is building a strong credit score. Now, you can buy a home at a 580, but you're going to pay a down payment. But you do have some programs out there that you don't have to pay a down payment, but your interest rate is going to be high. So you could buy a house at 630, 640, 650. Interest rate is still going to be kind of high. You want your ultimate credit score, you want it to get it to a 740 or higher, because between 740 and 850, your interest rate is going to be the same. So securing that credit score is the initial way to get in the door, but it's also your credit profile that ultimately gets you all the way there. So you need to make sure that your credit score is, in the 700s is a great way to start so you can get the better rates and terms, but your profile speaks volumes. So you need to make sure you have the proper mix of credit, revolving and installment. What is revolving? If you don't know, revolving credit is that those credit cards. Installment is like your home, like a mortgage or a car loan or personal loan, right? So those are some of the things that you can do to have a mix of credit. Most creditors are looking, or I should say most lenders are looking for you to have it for at least minimum, depending on your age now. The younger you are, the more lenient they are. But they want a minimum. They want six. So you can mix it up however you want it. You just need to make sure that you have a mix. That shows that you know how to handle money, because the lender is trusting you with a large amount of money at one time. So they want to see how you operate in different avenues and how you can handle that money. So you need to regularly check your credit report. Paying your bills on time is essential. That's 35% of your credit score right there. The other 30% is keeping that utilization down. So that's 65% between paying your bills on time and keeping the utilization down. When you're thinking about buying a home, you want to keep that utilization between the 6 to 7% of your, whatever your credit limit is. Okay. So make sure that you're keeping it low. 30% is optimum if you're, not in the search for looking for a home, but they want to see that debt. You want your debt to income ratio to be as low as possible. And making sure that you are putting forth some savings. Now, you do have first-time home buyer incentives where you won't have to pay any money out initially as far as down payment and maybe even closing costs depending on your income, but you still have to show that you can save money. So they want to see that money. So they want to see at least 3 months of your mortgage saved, and you're going to need money for your inspection, your appraisal, moving, if you're going to do moving trucks and all these different things, you're going to need money for that anyway. So if you take on the first time home buyer incentives, of course, your down payment, your closing costs, if you have enough money to buy down your interest rate, you can do that. What is that? So some lenders allow you to buy your rate down by points, and each point is like worth, depending on it, usually $1,000 a point. So you can buy that down so you have a cheaper interest rate if you have the money, right? So That's something that you could think about. But just maintaining that credit profile, that credit score, and having that money saved will definitely land you in a home. Current homeowners, right? Maintaining good credit can make sure that you're refinancing your mortgage is at a lower rate, right? Potentially saving you $1,000. Now, not just for refinancing, but you want a home line of credit, home line equity credit on your home loan. So on your, I should say, on your equity. What is equity? Equity is the amount of money that is basically how your house is housing this money because you pay down your principal and interest payments. Okay. You've paid that down. So you're gaining equity from there. But also in your neighborhood, your house is continually to increase in value. So that is equity. So it's increasing in value. You're paying your principal down so that you can get a home equity line of credit, but you have to keep your credit score in good standing. So what that home equity line of credit can do for you, you can do a lot of things with that because it's the money that you have housed in your house, right? And from your equity, you can invest it. You can buy another property. You can pay for college. You can do a lot of different things with a home equity line of credit. That's different from refinancing. Refinancing starts your mortgage all the way over. You don't want to do that. Okay, you want a home equity line of credit instead, so then that you can do whatever you need to do, and you basically gonna pay it back as you're paying your principal and your interest every month. Now, a way for you to pay off your mortgage faster is for you to pay an extra principal payment each month. You can do that for 6 months to a year, and you will see the lines decreasing. And if you can afford that, and you can pay your mortgage off between 7 to 15 years instead of 30. So that's just for the current homeowners. So back to tip number 2. So back to the first time home buyers, those of you that are first looking to buy a home, you got to create a solid budget and savings plan, right? I just spoke on the savings part. So budgeting help you understand your financial situation and identify areas where you can save more effectively. That's the whole point. You're looking for where your shortfalls are, where you're bleeding to stop the bleeding so that you can have enough money to not only, do the things you need to do initially in the home buying process, like your appraisal inspections, but you want to buy furniture. You want to be able to buy all the stuff that you need. And maybe you don't want to use credit. You don't want to damage your credit, but so you want to make sure that you have that money saved to buy those things, those essential needs you're going to need for your home. Especially if you're going from a smaller dwelling to a bigger dwelling, you're going to need some furniture. So you can use that money that you're saving from your budget windfall by looking at your budget for those items if you're a first-time home buyer, because you can use the first-time home buyer incentives to help you buy a home. Now, you might have to have, depending on your income, because FHA increased their buying limit to 750,000 in certain areas, because it was like 300 something, 500 something, depending on where you were in the country. And they increased it to 750,000. You can get first time home buyer incentive for 750,000. Now, in certain places, 750,000 is really not a lot of money to buy a house. But if you're in Texas or in the South, even here in Detroit, the South around the area, $750,000 house is a good house. Probably about 4 or 5, maybe even 6 bedrooms, depending on where you are in the city limits or outside the city limits. So I'm not saying you got to buy a $750,000 house. No, I'm just telling you that the FHA limit has got up to that point, and they were never that far up there. It was like 300, and they moved to 5, and they moved to 7. So take advantage of that, but you have to match the money saved in order to take advantage. So start by tracking your expenses by having a monthly budget. Allocate your specific amount each month towards your home purchase. So what I used to do when I was purchasing my home in 2010, I what I did was I took my money directly from my bank account, not my checking account, my paycheck, and deposited directly into a savings account where I didn't have hardly no access to it. I just, that's what I did to be disciplined. So you can do something like that too. Just directly take it. If you're not disciplined to transfer your money, because every time we get the money in our hands, we always find a way to spend it. So you want to make sure that you are taking that money and allocating it in the right way, right? So Being disciplined is taking it right directly out your check, and because you're not gonna miss it, right? Because you already know your budget, you already know what you're gonna do, you already know where you're gonna cut back and where you can and can't, right? So for current homeowners, a budget can help you for a plan for unexpected expenses such as repairs or renovations. Having an emergency fund ensures that you won't need to take high interest debt to cover these costs. As a homeowner, you need to know how much a roof costs, your HVAC, electrical, uh, plumbing, and foundation. Those are the five top ticket items for homeowners, right? So what you do is you say, for instance, if your roof only lasts 15 years, because they're not lasting that long, so you take that 15 years divided by the price, you'll know how much it costs yearly to save, and then you break it down, divide that by 12, then you'll know how much you need to save every month. Oh, my time is up. Every month in order for you to be able to get the home, get your roof done. That's an example. So I know people are up in arms like, oh my God, being a homeowner costs so much. Oh my God. No, it does not. If you plan for it and you budget for it and you save for it, it's not that maintenance is only going to happen every 15 years, 20 years, unless you want to do some high dollar renovations. Hey, Melissa. So it's up to you on how you do it. The maintenance only occurs when you let your house just sit. You don't do any maintenance, you don't do any work, you don't have any home warranties, or you don't have any homeowners insurance. But usually your homeowners insurance is already there in place because you gotta have that before you even close on your home. But the home warranties to keep up with those appliances, plumbing issues, all those different types of things, and some electrical issues, depending on, you got to read your policy. So make sure you read your policies, but that warranty will keep up with some of those things. So, paying into that could actually give you some savings, but also knowing the cost of those items and having that nest egg, that emergency fund. And because when they don't cover stuff, because insurance companies always try to find a way not to cover things, you'll have that money. Last thing, for future homeowners, what you need to do is, the last thing is managing your debt responsibly. We have to manage our debt responsibly, right? So high levels of debt can negatively impact your debt to income ratio, which I just discussed before. You don't want a high debt to income ratio, because the more debt that you have, the more riskier you look. And two, you're going to lower the value of what you can afford. Even if you have the money, they're going to look at your DTI. Okay. Now there's good debt versus bad debt. Now, if the debt that you have is high and it's making money for you, it is an asset and it's bringing money in, that's something different. But if you're bleeding in it, it's just not paying you, then they count that as a negative. So you need to make sure you know the difference between the two. If the debt is paying you back, that's positive. If the debt is just bleeding you, that's not going to be looked at as negative. So make sure that you are focusing on paying down existing debt however you need to do it. So you can do it in a snowball effect, where you start with the smallest one and then roll it up to the bigger ones, or avalanche effect. If you want to get crazy, if you want to, you want to be, wanting things done faster. So what you do is you take the highest interest and the highest balance, and you start putting more money towards that. And the money that you put towards that, you just avalanche it down to the next ones. And by the time you get to the small one, you just pay that straight on off. So that's just how that works. The snowball effect, you start with the smaller one and then you roll that money up to the next one, right? So it all depends on where you are. Some people are just not that disciplined, or are afraid to take that risk, or don't want to move a little slower, go at your own pace. So you want to make sure that you're paying off the high interest debt to free up your money for savings. That's what you need. You need your savings to be there. Hey, Brian. So you need to make sure that you're doing the things that you need to do as a future homeowner to make sure you're managing your credit and your credit report, making sure that you are doing your monthly budget so where you can see where you can save, and also managing your debt. When you're in a place where you're trying to buy a home, you need to make sure that you are keeping that utilization to 67% on your credit cards. And if you don't have enough credit, you need to get with somebody like me or some type of trusted financial advisor to help you build your credit up, right? Putting into place. I helped somebody last year do the same thing. She didn't like credit cards. She didn't like all these things about credit. And I just gave her little tips and some tricks, and she did them, and she's a homeowner right now. So current homeowners, so you want to avoid taking new and unnecessary debt. So because when you do that, you put more pressure on trying to pay off your mortgage. You got to prioritize paying your mortgage faster by putting that extra principal payment on there, so then don't have 30 years to pay, and then you can start doing that home equity line of credit and doing some investing and making your house pay you. That's good debt. So you want to be able to make those extra payments, but if you're getting these unnecessary debts by, buying all these things and doing all these things that's not paying you back, then it's going to be harder for you to pay for your mortgage, because that's the biggest debt that you have. So you want to make sure that you can save on interest and build home equity quicker by paying an extra principal payment, and then splurge out when you want to, once you build that equity and you pay down that mortgage. All right. So I'm done for today. All right. That's it. That's all. I went over my time by like 2 minutes. But just to recap, for future homeowners, the first thing you need to do is make sure that you're looking at your credit score. You want to have a 740 and up. But like I said, you can have a lower credit score. You're going to pay higher interest. You can get a first-time home buyer incentives with a 580 in some instances, but your interest rate is going to be high. You can get a first-time home buyer incentives for 650, but your interest rate is going to be high. So you want to get up to that 740 mark, making sure that you have at least 4 to 6 mix of credit, that revolving and installment. Revolving is credit cards. Installment is like your auto loan, personal loans, and things of that nature. You can also put your rent as an installment loan. Current homeowners, you want to maintain good credit, because you want to be able to either refinance, even though that's like put more time back on your mortgage, or get a home equity line of credit so that you can invest to make more money off your own house. So two, I said you got to keep a solid budget and savings plan. So future homeowners, you need to make sure that you seeing where your money is coming in, where it's coming out, where you have the shortfalls, where you're bleeding, and stop it, and learn how to be disciplined and saving and save that money, because you have to have at least 3 months of your mortgage saved. As current homeowners, you want to be able to have a nest egg for those unexpected expenses that are not covered under your home warranty or your homeowners insurance, because the insurance companies are not trying to pay. So roof, electrical, plumbing, HVAC, foundation. Those 5 things, you need to know the cost of those, how long it's going to take for you to be able to have to replace those things, and be able to take that cost divided by the years, and then take that divided by 12. You know how much you need to save every month. And if you need to break it down by weeks, you can do it even, by days or weeks or whatever. You can do the math, right? Have that nest egg. And lastly, managing your debt responsibly. You want to, for future homeowners, you don't want a high debt to income ratio. You want to make sure that you're paying down that debt before you get into the process, by either doing the snowball method, where you start with the smaller ones and then roll it up, or avalanche method, where you start with the highest one to take that risk and go ahead and wipe that stuff on out. So that's up to you. And then current homeowners, you want to make sure that you're not getting unnecessary debt, so it won't be hard for you to pay your mortgage. And you want to pay off your mortgage faster by paying the extra principal payment, so then you can build your equity faster, and you can start using that money to invest in something else. That's the whole point, right? So, all in all, are you ready, right, to take the next step in your home ownership journey? If you are, whether you're starting or you're looking to improve your financial strategy to be a current as a current homeowner, I can assist you. All right. So contact me today for your personalized consultation, or to continue your path in owning your dream home. I would love to help you do that. Let's make home ownership goals a reality, right? Realize your real estate riches. Okay, let's do it. That's my new group, so don't steal it. But I bid you adieu. I'll see you in these. I was about to say clubhouse, Lord. I'll see you in these social media streets, and everybody have an amazingly beautiful and blessed day. Bye.